Good morning, everybody. It's February 2nd. It's 11 a.m. here in New York. It's cold and supposed to warm up a little bit. We might actually get to the point where some of this ice melts, but right now there's a pretty good sheet of ice on top of the snow, so you can go ice skating, I guess. Haven't tried it, but I guess it's possible. At any rate, hope where you are, you're safe and warm. Weather's been it's been a pretty difficult winter so far compared to the past few winters. Just when I thought that climate change might not be might actually be benefiting New York with milder winters, we got a pretty severe one. But in the grand scheme of things, it's not terrible. So again, I hope you're safe and warm. Talking about safe and warm, it hasn't been safe and warm in the precious metals markets of late. Certainly on Friday, the knee-jerk reaction of the financial press was to attribute the decline in silver and gold prices, precious metals, to Trump on Friday morning announcing that he was picking Kevin Warsh to be the new Fed chair. And I guess the knee-jerk reaction was when people kind of did a quick look to see what Warsh was all about. It came across that he had the history of being hawkish when he was actually on the board of governors during the financial crisis. I think he was just about the only one who really opposed going for QE2. Even QE1 he wasn't crazy about, but he went along and voted for QE1. But other than that important liquidity measure, he thought that the QE2, QE3 really weren't necessary. I happen to agree with that, so that makes sense to me. But there was also a time back then when he disagreed with the FOMC's lowering of interest rates down to zero. He felt that that was really mucking around with the markets too much. The markets should be able to, at some point, set their own interest rate levels, and he thought that jamming rates down to zero on the Fed funds rate and trying to bring the bond yield down as well, that shouldn't be what the Fed does. And he was more concerned about inflation coming back. And again, we were kind of in the middle of the great financial crisis, and he was kind of raising a red flag about inflation coming back. So clearly, when you just kind of go back to his sense of what needed to be done back during the great financial crisis, he comes across as a hawk. But when you broaden it out and kind of bring it up, his views up to date, and see what he's been saying of late, it changes so much. Back to the gold story, I don't really think that the gold story and the silver story were in fact triggered by the appointment of Warsh. It turned out that I was watching it the night before, and the gold was coming down. Now I think maybe the markets started to perceive that some of the uncertainties that were out there were diminishing. So, for example, there was some reporting about Iran being willing to negotiate with the United States. So that was one thing. And then I think it was on Thursday that the White House said that the president would announce his pick for the new Fed chair. And so that was another area of uncertainty that was somewhat reduced. Minneapolis is still a horrible mess, but there was some indications that the administration is trying to cool things off in that confrontation. So it looked as though some of these issues that were out there that might have been rallying silver and gold might be moderating somewhat. But in any event, I wasn't watching silver, but gold was down Thursday evening. I think it was down as much as a couple of hundred. Again, maybe it was the market anticipating that we're going to have a Fed chair and this issue will be behind us. But then during the day on Friday, the CME group, the exchange, decided that because of the volatility in the silver and gold market, they had to raise margin requirements. I think they did that around 1 o'clock Central Time and 2 o'clock Eastern Time. And I think they also, not only did they raise margin requirements on gold and silver, I think they did in a couple of the other precious metals, copper as well. And that meant a lot of the leverage that we get in the precious metals in the futures markets had to consider whether it wanted to remain leveraged and make margin calls or cash in the chips. So there's a lot of cashing in of the chips going on with regards to that margin call issue. I'm still sticking with my 6,000 by the end of the year. I had been thinking 5,000 by the end of the year, but when we got to above 44,000 with a lot of when we got above 5,000 with a lot of strength that kept taking us up even further. I think we got as high as 5,500. I raised my number to 6,000. I'm going to stick with it. Don't want to rattle the chains too much with that forecast. And at the end of the decade, it's still 4 years away, and I think 10,000 is reasonable. Now, I've conceded before, I've acknowledged before, I've said before, I don't really have any model with which to price gold or Bitcoin for that example, and I've argued that they're kind of similar in nature in that they don't really have they don't generate any income that one can discount to and give it a present value. I have argued that the only kind of model, if you will, that I have is one that where you put and I've shown you this chart before. You put the S&P 500 on the same chart as the price of gold, using exactly the same scale. And what you see is that on a cyclical basis, the S&P 500 and the gold price tend to be inversely related, which corroborates that gold is a good diversifier for a portfolio if you want to take some of the volatility out of the portfolio. So in the past, when the stock market went up and gold either stayed flat or went down, it reduced the upside volatility. But at the same time, when the stock market went down, gold tended to go up, and so you reduced your volatility to the downside. But not that many portfolios viewed gold that way, and the gold wasn't really viewed as much of an asset until this recent run up. And I think we did see. I think one of the houses on Wall Street said that you should have 20% of your assets in gold. I didn't come out with a specific recommendation like that. I just said that I think the central banks are buying it. I think the Chinese investors are buying it. I think geopolitical risk is still substantial out there, and that as the stock market goes up to 10,000, now that's also kind of an out there forecast, but at least I have some way to justify it because I think without a recession happening, it's reasonable to believe, and I don't think we'll have a recession because I think the economy has already demonstrated its resilience since the beginning of the decade. So I think we'll continue to have the roaring 2020s economy through the end of the decade. And without a recession, I think it's reasonable to get to $500 a share for the S&P 500, not by the end of the decade, but the beginning of the next decade, 2030. And I think if the market anticipates that number in 2029, then $500 would be the forward earnings in 2029 times a multiple of, let's say, 20 would get you 10,000. So on that chart that I mentioned, and you've looked at before, I hope, what we've seen is that the trend of gold and the stock market tend to be quite comparable. So they're inversely related cyclically, but the trends pretty much match. And so I think that if we get to 10,000 in the S&P 500, gold could get to 10,000. And the idea is that as the stock market goes higher and higher, uh, people feel a little bit less comfortable with it. It's been a great bull market. They've made a lot of money. There's a lot of things to worry about. They don't want to give it back. And so there could be some diversification a into gold in that scenario that would take it up to 10,000. So that's the logic of there. But I don't want to go down in my career as being a gold bug or having been prescient or totally wrong about gold. I'm just kind of laying it out there for you the way I'm thinking about it. Obviously, my day job is to forecast the S&P 500, and I think I've had a pretty good track record of it. And one of the reasons I think I've done reasonably well for you over the years is that I listen to Fed chairs. I've had this view that Fed chairs, you really have to kind of get into their heads and think of the way they think because they do tend to dominate where the FOMC is going to go. And by the way, the Fed chairs tend to be consensus builders. In other words, they had their opinions and they try to persuade other Fed voters, FOMC voters, of their opinions. But at the end of the day, they didn't want to be dissenters. They didn't want to be out there all by themselves. And so they would moderate their views to reflect what the consensus of the committee was. So they'd push and pull their colleagues to kind of agree with them. But when there was pushback the other way, they moderated their views, and lo and behold, almost always, except maybe when Volcker, well, I'm not sure about that. Let me not go there. I'll double check that. But we've, to my knowledge, never had a Fed chair who was a lone dissenter or one or two of the dissenters. So that's something to consider when we're considering Kevin Warsh. Now, I wrote a couple of books on the Fed, which I'll remind you about again. This is Fed Watching for Fun and Profit. And after that, I wrote The Fed and the Great Virus Crisis. If you want freebies of them, the PDFs are available on the website. Just go to the top banner, and on the banner it says More. Click down on More, and it says Dr. Ed's books. So you can look at it there. But looking at the Fed Watching for Fun and Profit, what I did is every chapter or every couple of chapters, depending on the Fed chair, I would do I would focus on the Fed chair at the time. For example, let me put on my reading glasses here. For example, for the first chapter is called "The Committee Talking Heads," about all the Fed officials on the FOMC that like to talk a lot. Then the first one Fed chair that I start out with William McChesney Martin, and that's subtitled Punch Bowl. He famously said that the Fed's job is to take away the punch bowl just when the party's starting. Arthur Burns and G. William Miller get teamed up in one chapter, so I didn't have a lot to say about either one of them, other than to call them the hapless inflators. Paul Volcker, I called him the great disinflator. Alan Greenspan, the great asset inflator. Ben Bernanke, the great moderator. Janet Yellen, the great normalizer. And then Jerome Powell, I called him the pragmatic pivoter. I think those all kind of still make sense. Maybe some of you have some alternative suggestions. One of these days, I'm going to have to refresh the book, and I think I wrote about Powell's first term, but the second term of Powell was mostly in this book. But I got a couple of years that I got to catch up on, and now I'm going to have. I think I'm going to have Kevin Warsh if he gets through Congress. I think that'll require the president to back off on his attack of Jerome Powell, at least the court case issue. Look, I think it's really pretty simple with Trump. He just didn't like Powell. He didn't like him that much during his first term, and he liked him even less during his second term. And he really didn't like him during his second term, but because Powell lowered the FOMC lowered the federal funds rate by 50 basis points before the November elections in 2024. I think that really annoyed the hell out of the president, and he's been kind of beating up on Powell ever since. So maybe a lot of this was just getting rid of Powell and replacing him with somebody that he likes better. He has said that one of the reasons he likes Warsh is because he looks the part. He looks like he came from central casting, and he mentioned that he's young, which helps me kind of mollify myself. I was kind of hoping that I'd be a candidate. I mean, I wrote a couple of books on the Fed. I have expressed opinions about the Fed. I've even offered to do what the Fed does for half the price. The president's been upset about the renovations. Well, heck, I would have done it from home, right from this office with my staff, and we would have done it for half the price. But then again, I have been against lowering the Fed funds rate since 2024, arguing it wasn't really necessary, and arguing that the bond vigilantes would offset the easing of monetary policy. So obviously, I disqualified myself right there and then. But I don't know. I don't know what you folks think, but I could, if I put on a tie and a jacket, I could look more like a Fed chair. But anyways, we wish Kevin Warsh all the best, and he's a real insider. I mean, there's a clique of these folks who are very well connected with each other. They know each other. With the benefit of hindsight, it's kind of like a dumb moment. We should have known that it was going to be Warsh. Warsh and Bessent were the Secretary Bessent. Both worked for Stanley Druckenmiller. I don't think they didn't work for him at the same time, but clearly it's part of the Stanley Druckenmiller fraternity. Both of them worked for Stanley. And so they know each other. And then I noticed that Treasury Secretary Bessent wrote an article in the International Economy magazine about half a year ago, I think it was, maybe a year ago. And no, it must have been, it's last year, a couple of months into the administration taking over the White House, that Bessent wrote this article, and it was all about criticizing the Fed and how the Fed should stay in its own lanes, and the Fed's using all of these models which have nothing to do with reality, and it really was very critical of the Fed. And then over the weekend, I'm kind of catching up on Warsh. I hadn't really followed him that closely. I always thought he was a bit of an outlier, but so I followed Warsh. I read all the stuff on Warsh very carefully. I said, this sounds like that article in the International Economy. And if you want a link to that article, just to take a look at the morning briefing, which is titled Meet Kevin Warsh. So not surprisingly, in that context, Warsh has several times over the past few months been talking about a regime change at the Fed, and also he's been talking about a Treasury-Fed accord. And when he talks about the Treasury-Fed accord, he's clearly reminding us of the Treasury-Fed accord back in 1951, which kind of freed the Fed to be independent from the Treasury. During World War II, the Fed basically kept interest rates very low so that the Treasury could sell government bonds and reduce its financing costs during the war. But then in 1951, the Fed came back to the Treasury and said, the war is over, and we've got an inflation issue now in the country, and we've got to be free to do what we need to do. And so the Fed became more independent at that point. So the Fed really wasn't very independent during the wartime. So the idea that the Fed's always been independent is not true at all. But then Warsh wants to bring this accord, and this accord in some ways can be argued as making the Fed less independent. because it says that I really prefer to call it the Besant-Warsh Accord. They're clearly talking to each other. They're clearly on the same page. The language they use to describe they want to do and what the economy will be doing under the Trump administration is almost identical. And so they're basically both supply siders. Warsh really comes across as a supply sider. So my chapter on Warsh is going to be called Kevin Warsh Supply Sider. And he's several times said that and endorsed Trump's policies as in effect supply side policies, lowering tax rates clearly is a supply side policy. Deregulation is clearly supply side. And in the past, the Fed officials stayed as far away as they possibly could from saying anything about fiscal policy. They even left the dollar policy making up to the Treasury. Anytime a Fed chair was asked about that, said, "Well, the Fed doesn't do that, and we don't comment on fiscal policy." And Warsh is kind of saying something reasonable. He said, "Well, that's ridiculous. How can you have economic policy, which depends on fiscal and monetary policy? How can you have them kind of at cross purposes? You can't. They didn't say this, but this is, I think, a useful analogy. You can't drive a car by stepping on the accelerator and the brakes at the same time." It's conceivable that could happen from time to time if the Fed and the Treasury don't get their act together, and they should get their act together, is the logic there. So I personally don't really have much of a problem with them having discussions and all that, but I think the Fed's independence remains very important. And I guess Warsh is saying the Fed will be independent. It's just going to be independently choosing what Kevin Warsh, choose the policy to be. And oh, by the way, it just happens to be fully in line with what Besant believes and what Trump believes. And what they both believe is that we can have a golden age of economic growth in the United States with much better than expected growth. And Warsh is particularly over and over again seems to be completely have embraced the idea of AI productivity growth, and that productivity growth is going to give us better real GDP growth, lower inflation. And if that's the case, then the Fed, the monetary policy, should cooperate with all that. Because after all, if the fiscal policy is going to get inflation down and give us growth that's non-inflationary, why should the Fed fight that? It all makes sense to me. And the reason it makes sense to me is this sounds kind of familiar. We've been talking about the roaring 2020s since 2020, and arguing that we would have a productivity led boom that would keep inflation down. So it all works for me. So what's my problem? Well, my problem is that I'm not convinced that we really need lower interest rates. If the economy is already doing so well, if we can already anticipate, as Warsh believes, that inflation at 3% will come down to 2% because the inflationary impact of tariffs will diminish because it's a kind of a one-shot hit to prices. If productivity is going to continue to grow solidly, grew very solidly last year, then inflation is going to come down. Then the Fed should look through 3% inflation and see beyond that it's going down to 2%. And so why not enable the roaring 2020s, the golden age, with lower interest rates? So it's kind of in my interest to have them lower interest rates in terms of promoting my scenario of the roaring 2020s. However, while Warsh is very much both a expert in markets because he worked in a hedge fund, he worked for one of the great ones, Stan Druckenmiller, and he's certainly an expert in economic policy making. It seems as though we're kind of like on different paths here. I think that lowering interest rates when the economy doesn't really need it misallocates capital, which, by the way, ironically, is what Warsh has been saying about the Fed's lowering interest rates to zero and the balance sheet expansion. Well, Warsh wants to reduce the balance sheet, so he figures that if he's kind of tapping on the brakes of monetary policy by reducing the balance sheet, then that should give him more room to lower interest rates giving both Besant and Trump what they want, and he feels intellectually fully on board with that, then why not do that? Well, the answer I think is lowering interest rates when the economy doesn't need it, when the stock market's record high, when at least until late last week we had a melt up in precious metals prices. Maybe lowering it just gets you more of a melt up, not just in precious metals, but more importantly in the financial markets. Maybe you let the zombies live longer in the private credit markets, and maybe you just create a melt up, melt down scenario, which would not be something that any of us would welcome. And I mean, I guess melt ups are great. I'll just have to tell you when to get out right at the top, and then we sit in Treasury bills and wait out the next bull market. But it's much saner, better for the economy, for the long-term growth of the economy if we don't get financial instability resulting from the Fed being too easy. Remember, the Fed's original reason for being was financial stability, to avoid financial instability, to avoid financial crises. And so that's kind of where I'm coming from. Now, of course, wouldn't you know it, Warsh is going to be replacing Powell on May 15th. I believe that's the date. And by then, we could have an economy that's absolutely booming. It certainly boomed last year. And we just had the purchasing managers index come out for January, and I'm a little bit hypocritical with that index. I've been telling you that the purchasing managers index is useless because it's been too pessimistic. I've been telling you that the consumer sentiment index is useless because it's been too pessimistic. I mean, that's just an observable fact. They've been too pessimistic. Economy's been much stronger. The consumer's been much stronger. Capital spending's been much stronger. Well, I'm going to tell you now, it's good data, good data now. Now it's supporting my story, so I love it. And it's telling you the economy is resilient. Even manufacturing is coming back. It's only 1 month, but I'll take it. But what if, with all this refund checks that are going to be bigger than they had been before, we get a really booming consumer capital spending going on the first half of the year? Is Warsh going to be able to lower interest rates from the get-go? Is he going to be able to cut the Fed funds rate, or is he going to be a dissenter? Could he be the lone dissenter? Because other Fed officials are still data dependent. They're still stuck with models that he doesn't agree with. They still worry that if the economy is too strong, inflation might come back. That's the Phillips curve. I don't agree with that model either. I'm very sympathetic to a lot of Warsh's positions, but I'm also kind of practical and pragmatic about what we're dealing with here. And so it's conceivable. I mean, I guess if the Fed in June votes unanimously not to cut interest rates, then obviously Warsh has been tamed by the economy and by the other Fed measures to cool his jets and not push too hard for a rate cut. We'll see. It's going to be fascinating up ahead here. Certainly might motivate me to write a follow-up. Maybe I'll just put all the Fed books together and call it "Don't Fight the Fed." That sounds like an original way to sell the book. Anyhow, so let's go here to a couple of the questions here. Michael, in your opinion, what does it mean for the market when both the S&P and gold are moving in the same direction? It's a good question because, again, on a short-term basis, they have tended to be inversely related. That doesn't mean that day by day or month by month that has to be the case. But I would say that, kind of my knee-jerk response to your question, my kind of off-the-cuff response is that the world's never been wealthier. There's just an enormous amount of wealth. It's gotten wealthier and wealthier, not just in the United States. They're very, very rich people with huge portfolios. There's lots of people that have portfolios of assets and are retiring in 401ks and the like. And there is sort of a diversification going on here. So if the market, it's kind of what I said before, if the market's going up, and some people are feeling a little like maybe it's time to rebalance, to take some profits. How much higher can this market go? I'm worrying about the deficit. I'm worried about this and that. Well, how do I guard myself against geopolitical risk? So gold goes up. So that's kind of the way I look at it. Willem, when the Monetary Policy Committee voted, Governor of the Bank of England, Eddie George, was never in the minority. He always voted last. Thank you for that. Um, and Willem knows because he was there. Ian, your thoughts on Warsh policy on balance sheet seems to be a contradiction or disconnect with no QE or reducing Fed balance sheet policy and additional supply of treasuries to fund government spending and ample reserve risk. Look, I think there's another kind of flaw here in the supply side view coming out of the administration, and that is, what about the deficit? What about debt? And their knee-jerk response to that is that, well, don't worry about that. We're going to have better than expected growth. Better than expected growth means better than expected revenues, so that'll reduce the deficit. And if it's better than expected growth, guess what? The deficit to GDP ratio and the debt to GDP ratio are going to go down. So growth solves everything. Well, maybe so, but there is an accounting problem in that the deficit is huge. And instead of doing anything right now to contribute to actually narrowing it from just an accounting standpoint, slowing the growth rate of outlays, increasing the rate of growth of revenues, instead of that, the president's talking about increasing defense spending by 50%. I personally like defense spending. I want to be protected. I don't really have a problem with making sure that we have the best defense possible and spending on that. But maybe we got to pay for it with taxes. I'm just kind of thinking out loud here. I just don't get that doctrinaire about these things. I just try to get the markets right. So you can't be the doctrinaire. Okay. Firstly, you're 100% in line for a future Fed chair stint. Thank you. Count my vote. Thank you. Secondly, amid a mad rush to de-dollarize and the Don's mad rush to spend, besides being the world's unipolar superpower, are there any fundamentals under your hood that are bullish for the dollar? Yeah, I mean, foreigners are buying. The Treasury's data on foreign purchases of U.S. securities comes out every single month, and data's a little stale. It's through November, but through November, foreigners bought about basically a record 700 billion over the previous 12 months through November. They bought $700 billion of equities, all-time record high. I think it was actually a couple of months before that, but so maybe it was like 690 or something like that. So we're in record high territory in terms of foreign buying of equities. And the same thing is true of fixed income securities. It had been like a little over $1 trillion a couple of months ago on the 12-month basis. Now it's like 900 billion. So foreigners are still buying. And oh, by the way, how about all this direct investment that the president is piling up here? As sort of, a sign-up bonus that others have to pay by investing in the United States. Maybe that's what we're seeing here in the purchasing managers is some signs that all this effort to onshore might finally be working. Who knows? Just kind of, it's just a 1 month thing, so we don't know. But I'm not bearish on the dollar, and I think the dollar is still the safe haven. So if there's still lots of geopolitical risk, I mean, who knows what China's going to do next? Even China doesn't know. President Xi just got rid of all of his generals, so he's the only one making up policy now, military policy. He doesn't have anybody else to talk to about it. So who knows? Richard, if Warsh cuts the rate to 2.5%, I think he'd be talking more like, yeah, you're right. The FOMC thinks they should get it down to 3% over time. They think that's neutral on average. That's their average consensus. Warsh, if he wants to placate the president, needs to get it closer to 1%. But now that Trump can move on to other things, maybe he won't beat up on the Fed as much. But okay, if Warsh cuts the rate to 2.5% and enacts bank deregulations, but reduces the balance sheet to 4 trillion will the financial conditions become tighter. So yeah, that kind of relates to the previous question that I didn't answer properly, and that is if he succeeds in convincing Fed members to cut the balance sheet, and there is some practical issues of the amount of reserves that the banking system needs. So it's not cut and dry that he can even reduce the balance sheets, but he wants to reduce the balance sheet. So that would be tightening. And in his mind, that would give him more space to lower interest rates. And so that would be the justification for lowering interest rates. Remember, the Besant and Warsh have a admirable and almost non-elitist view, a non-billionaire's view of what they want to accomplish. They want to accomplish policy that's good for Main Street, even if it's bad for Wall Street. They sound like populists, right? I mean, billionaire populists. They want to do good. And so Warsh thinks that one of the ways to do that is to reduce the balance sheet, which he thinks has been beneficial to Wall Street and on Main Street. And on the other hand, lowering interest rates would be more beneficial to Main Street. Francis, hi Ed, what's the technical limit to a combination of shrinking the balance sheet and cutting the federal funds rate? Became a problem in 2019. Last time that happened, almost seems like a curve steeper trade. Absolutely, Francis. And again, it gets to the question of whether it's even possible to reduce the balance sheet without running into a shortage of reserves for the banks and creating a crisis in the short-term money market for banks. I'm going to overstay my welcome here because there are more questions here, and this is kind of a interesting topic for all of us. Jose, what would have to change for central banks to stop being net buyers of gold? Nothing. I think they're committed to buying gold, especially the bad actors, the ones that we perceive as bad actors. They want to they're the ones who want to de-dollarize, and they're voting with their purchases of gold. Lee, does the CME increase of margin requirements impact foreign purchases of precious metals? Foreign purchases of them would seem to be contributing to the recent rise in price. Look, the price is basically set in the futures markets. That's where the liquidity is for silver and gold, and that's where the leverage occurs, and that's where the margins occur. So the margins are completely restricted to the futures markets. They don't have any impact to anything that happens in the spot market, as far as I'm aware. Warsh, whoa, you guys are keeping this fast and furious. Well, why not? Let's see. JR, Warsh has said he wants to shrink the Fed's balance sheet in the backdrop of a strong economy. Is it feasible to do this while keeping Treasury yields? Okay, we've covered that, I think. Ted, hi, Ed. The PPI was higher than expected. I'm glad you mentioned that, because I mentioned that the PPI just came in hotter than expected, and it's 3% on a year-over-year basis for the headline, and the core is 3.3%. And there's some evidence that maybe only now are companies starting to say, we're not going to eat this anymore. We're going to pass it on to consumers or customers. And then, of course, we had the PPI, the ISM data today. So suddenly the economy is going to look red hot, and I will be vindicated with the benefit of hindsight in my view that the economy doesn't need interest rates to be brought down. Nick, one last, okay, we're down to the end of it here. Last question, stablecoin. In your newsletter, you pointed out that for Warsh to be successful, reducing the Fed's balance sheet, an alternative source of demand for treasuries will be to supported by stablecoin. What if stablecoin doesn't get implemented, or even if it is not well accepted in the marketplace? Well, I'll just cut to the chase here. Stablecoin is a smashing success. It's already out there. It was legitimized by the, I just forgot the name of it, the Genius Act. Anything that's called the Genius Act's got to raise some contrary instincts in all of us. But the Genius Act said it's legit. Here's the way it needs to be operated. It needs to be backed up by liquid assets. Treasuries are clearly going to be the preferred liquid asset, and apparently it's succeeding extremely well in emerging markets that don't have very good financial system. I think it'll succeed. I think that Treasury is counting it on being an important source of funding for the Treasury. But it's kind of a gimmicky thing in terms of Treasury funding. It's a way to say, okay, between that and better than expected growth, we're not worried about the deficit. We're not worried about the debt. And I say, well, I'm going to keep watching the bond vigilantes, see their reaction. So far, they seem to be so busy in Japan that they aren't doing much over here. And I'll be watching the stock market for signs that the market's figured out that this is all going to be kind of a melt-up situation. Maybe the fact that the melt-up in precious metals just got its comeuppance will kind of cool things off. But sentiment can change around pretty quickly. Anyways, a lot of interesting things. It's intellectually fun for sure. Now let's see if we can make some money trying to figure it all out. Thanks a lot.